there's a question about why has our portfolio 100, that's our globally diversified, small value tilted equity portfolio, why has it done so poorly relative to a S&P 500 ETF, for example? And so I want to use a little tool that's available here in Zoom called a polling tool. And I'm going to pose some questions to the, how many of you? 136 of you. So get ready to put your thinking caps on. And I'm going to bring up a question here. So here is my first question to you. If you owned a portfolio that was 50% NASDAQ and 50% S&P 500, what would be your benchmark? And so get some interesting responses here, but what I like about this is we're capturing the wisdom of the crowd, if you will. And it seems like the overall winner is the 50-50 blend of a NASDAQ and S&P 500. So here we can see the results were 62 for the 50-50 blend, 15 for the S&P, and only 2 chose NASDAQ. Now that's kind of interesting. Why more on the S&P than the NASDAQ? My guess is it's a little more accepted general benchmark than the other. But the answer is this 50-50 blend. All right, so let's make this a little more complicated by taking 40% NASDAQ, 40% S&P, and let's add that small cap index, the Russell 2000, with 20%. Now, what do you think is your proper benchmark? All right, so I'm going to now share those results with everybody. So now we see that a 40% NASDAQ, 40% S&P, and 20% blend seems to be the crowd's opinion of the best benchmark, given the fact that that's how you've invested, right? So if you have 11 indexes, as you see in Portfolio 100, what is your right benchmark? The allocation that you have in that index? Or are you going to pick one of them? Russell 2000, emerging market value. Which one of these are you going to select to be your benchmark? And what we see here is that we have an overwhelming opinion that your best benchmark is the blended benchmark. And that, I think, is the main point I'd like to make about this. The wanting to beat a benchmark goes back to the active investing world. And we're not really in the business of trying to beat some particular benchmark. And instead, we're trying to assemble a group of benchmarks, a group of indexes from all over the world, provide that diversification, and also look at the academic research on the dimensions of returns and small and value and now these profitability factors, and really try to build portfolios that have the highest expected return over the very long term. Now, expected is a loaded word, and it really refers to the fact that you're not going to get it. It's expected. And really, if you think about future returns, they're like bell-shaped curves. And all the expected really means is it's the center of a future probability distribution of returns. But I do happen to have a historical chart that looks at the blend of these 11 indexes against one of those indexes. And it can give you and remind you of this difficulty of trying to be in a position where one investment does better than another. And so we're in the 10-year range maybe now of where we have not seen a premium, maybe even 15 years. But what are the probabilities of that based on some 50 years of data? Well, in 10-year periods, roughly 1 in 3 10-year periods, you would have been better off here in that S&P 500 versus that blend. by the way, it's on the other side, it's 68% advantage for owning that. But if you end up in one of those periods, that should be expected and it should be accepted because these are random outcomes. The active investment world wants an explanation for these results, when in fact there isn't one. It's market randomness, and market randomness has to do with the fact that the market's always setting a fair price. And then from that fair price, it resets everything so you're starting from a more even point of view. But look at this, even in 20-year periods, here's a roughly 10% of the time where you would still be better off owning that S&P 500. So 1 in 10 of those periods, you would be better off in the other one. So I think the best thing is not to torture ourselves over our good or our bad luck, and mostly with our bad luck, we want to torture ourselves in the fact that in 1 year period, we didn't win, we didn't beat something. This is not about winning or beating. It's really about understanding the long-term research that says when we look at the long-term averages, we see that there has been an advantage to tilt towards these factors of size, value, and profitability. And in designing diversified portfolios, we want to look at this long-term data and target it as we put together these portfolios.